This is disappointing, clearly. Is this the worst of it?
Yes, so today we've announced our FY18 annual results. Very disappointing to have to announce a loss of $196 million. The major drivers of that, of course, are the two one-time events that hit us with the Danone arbitration settlement, as well as the impairment we took on our Beingmate investment. But even aside from that, the underlying operations performance on an earnings basis is disappointing, with normalized EBIT down 22%. Of course, that's also on the back of a very strong milk price this season, with $6.69 per kgms. That, together with a 10-cent dividend, is good news for the farmers in the sense of a cash payout of $6.79 per kg, which is the third highest in the last 10 years. Nevertheless, we have to do better from an earnings perspective going forward.
And does that include, you've spoken about this strategic review of your assets. Should we be expecting divestments in the future?
Look, all options are on the table. Part of the approach going forward is, first of all, it starts with taking stock of a complete stock of our business. We're looking across all of the assets we have, the partnerships, the various businesses, looking at what's needed to improve, and we'll take the necessary actions. But all options are on the table. But in addition to that, it's also about just going back to basics to improve parts of our business, and thirdly, it's about also improving the quality of our forecasting.
When could you be resuming your dividends?
Yes, so we announced 10-cent dividend for FY18, which was the same dividend at interim. So going forward, that depends on, of course, our ability to deliver on earnings, because we have to do this in a disciplined way. We have to maintain a strong balance sheet, and that's also part of the measures that we have to take. It's delivering on better earnings, but it's also getting our debt situation back into balance.
How much of that strategy will depend on China?
China is an enormously important strategic market for us. It represents about 25% of our business. Overall, we're very pleased with the performance that we've made there. It's a significant part of Fonterra, but we're also a significant part of the dairy market there, and very proud of how we've done. This year, for the consumer business, actually, we've broken even, which is 2 years ahead of plan. But nevertheless, of course, as part of the integrated China strategy, we're disappointed with the progress in Beingmate, and we also are continuing to make progress with our China farms.
Does that suggest an exit from Beingmate, or perhaps a larger stake in Beingmate?
Well, look, all options are on the table, and on our investment with Beingmate. But what certainly is also the case is we have to take an integrated approach to our China strategy.
Mark, tell me, are there question marks over what sort of capital constraints the business is facing at the moment? And are there also, is there also a question mark over whether you'd be sticking to the cooperative structure?
Yeah, look, in terms of capital structure, we don't have any plans to change that. Really, the issues that we have to address right now are really around performance. We have to deliver more earnings. We have to get the right relationship between the level of earnings that we have and the level of debt on the balance sheet. I think once we have performance turned around, good performance really supports a range of capital structures, and no capital structure is going to be a solution to unsatisfactory performance. So it's really about going back to basics, getting the forecasting right, and taking a stock of our business to turn things around.
When it comes to next year, 25 to 35 cents, how realistic is this when we're seeing projected milk costs to remain similar to last year?
Look, we think that's realistic. Again, part of the forecast approach we want to take is to really have to be realistic about what's possible. 25 to 35 cents shows an improvement over FY18. Certainly, we're operating in a volatile business. We understand that, but we also are confident in the strategy going forward. It's about capturing more value for the milk. We've made progress on that in spite of the earnings performance. We've actually made progress in terms of selling a greater proportion of our milk in higher value-add products, going from 42% share of our LMEs in high-value products up to 45% in 18, and we need to continue to make progress in that direction.